Every time the market crashes, most people lose everything. But a silent minority, insiders, billionaires, hedge fund legends, they use those crashes to get even richer. In 2008, when banks were collapsing and the media screamed end of capitalism, Warren Buffett wired $5 billion into Goldman Sachs. That single move made him billions. In 2020, while the world panicked, elite investors scooped up blue-chip stocks at fire sale prices and doubled their wealth in under a year. The difference? It's not luck. It's not timing. It's a playbook. You don't need to be a genius to follow it. But you do need to understand one truth. Crashes don't destroy wealth. They transfer it from the unprepared to the prepared. So the real question isn't if another crash is coming. It's, will you be one of the victims or one of the few who knows exactly what to do when it hits? Welcome to Capital Uncovered. Today we're exploring the art of turning market chaos into generational wealth. The anatomy of inevitable collapse. To master the market, you must first understand its nature. Markets don't just crash, they exhale after periods of excess. Like seasons, markets move through predictable cycles: accumulation, markup, distribution, and decline. The wise investor doesn't fight these cycles, they align with them. The Great Depression erased 86% of investor wealth. Black Monday 1987, 22.6% gone in hours. The dot-com implosion, $5 trillion vanished. The 2008 meltdown, $8 trillion erased. The pandemic panic, the fastest crash in history. Yet after each collapse, markets not only recovered, but reached heights that would have seemed impossible in the depths of despair. This isn't coincidence. It's opportunity, if you understand what others don't. Act 2, the 4 Horsemen of Market Collapse. 4 warning signs precede every major market collapse. Learn to recognize them, and you'll never be caught unprepared again. The first horseman, overvaluation. When prices detach from fundamental reality, collapse becomes inevitable. The Buffett indicator, total market capitalization to GDP ratio, has signaled danger before every modern crash when exceeding 140%. When companies trade at 30, 40, even 100 times their earnings, they're not being valued on reality, but on dreams. And dreams eventually meet daylight. The second horseman, excessive leverage. When investors, companies, and economies build mountains of debt to finance speculation, they're not creating wealth. They're borrowing it from their future selves. Margin debt peaks have precisely marked the 2000 and 2008 market tops. When everyone borrows to buy, eventually someone has to sell to repay. The third horseman, euphoria. When taxi drivers give stock tips, when dinner conversations center on getting rich quickly, when financial caution becomes financial weakness, the end approaches. Euphoria isn't optimism, it's intoxication. And like all intoxication, it ends in sobering reality. The fourth horseman, divergence. The most subtle sign, when markets appear strongest on the surface, but beneath, the foundation crumbles. Fewer stocks making new highs. Small companies lagging behind giants. Volume decreasing as prices increase. When all 4 horsemen appear together, as they inevitably do, the masses panic. The prepared prosper. The psychology of wealth destruction. Market crashes aren't primarily economic events, they're psychological warfare. The human brain evolved to survive immediate threats, not to build wealth over decades. Your instincts, the very ones that protected your ancestors, now betray you in markets. Fear of missing out, FOMO, hijacks your rational thinking. You see neighbors, colleagues, even strangers getting rich. Their stories torment you. So you leap in, precisely when you should step back. Then comes herd instinct. Millions of years of evolution programmed us for safety in numbers. But in markets, the herd doesn't lead to safety. It stampedes off cliffs. Finally, panic. When markets collapse, decades of financial dreams disintegrate in hours. The exit door becomes a keyhole, and everyone tries escaping simultaneously. But there exists another path, the path of emotional mastery. When others panic, you remain centered. When others act on impulse, you follow strategy. When others see disaster, you see opportunity. This isn't just philosophy, it's the foundation of generational wealth. Act 4. The all-weather portfolio. The first rule of wealth isn't making money, it's not losing it. Rule 1. Never lose money. Rule 2. Never forget Rule 1. Warren Buffett. The truly wealthy don't chase returns. They build fortresses that withstand any storm while positioning for growth in any climate. This is why legends like Ray Dalio developed the all-weather portfolio. 30% in quality stocks for growth. 40% in long-term bonds for deflation protection. 15% in intermediate bonds for stability. 7.5% in gold for crisis insurance. 7.5% in commodities for inflation protection. When stocks crash, other investments often rise. When inflation surges, certain assets protect while others suffer. When interest rates shift, some positions strengthen as others weaken. This isn't diversification for its own sake. It's strategic positioning for inevitable cycles. Instead of succumbing to fear or greed, you simply rebalance, buying what's down, trimming what's up. The strategy removes emotion from financial decisions when emotion is destroying everyone else around you. Beyond traditional assets, the wise build positions in tangible wealth that thrives during systemic stress. Productive land, select precious metals, essential businesses, and scarce assets with intrinsic value, not as speculation but as foundation. Act 4. The opportunity in chaos. What if market crashes weren't threats, but the greatest wealth-building opportunities of your lifetime? After every major crash, markets haven't just recovered, they've soared to unprecedented heights. Those brave enough to invest when blood runs in the streets haven't just survived, they've become the next generation of financial legends. By consistently investing through downturns, dollar-cost averaging, you transform other people's panic into your prosperity. Look at this. $1,000 invested monthly in a calm, rising market builds wealth gradually. That same $1,000 in a volatile market that eventually recovers? It accumulates dramatically more shares at lower prices, potentially doubling your long-term returns. Miss just the 10 best days in the market over 30 years? You sacrifice 54% of your potential wealth. Miss 20 days? You lose 73%. Those best days almost always come right after the worst crashes, exactly when most investors are hiding in cash. John D. Rockefeller accelerated his buying during the Panic of 1907. J.P. Morgan famously bought stocks during the darkest days of market collapses. Warren Buffett invested $5 billion in Goldman Sachs during 2008, later netting billions. Not luck. Strategy. Different sectors thrive in different market phases. Early recession. Healthcare, utilities, consumer staples. Late recession. Technology, financials, consumer discretionary. Early recovery. Materials, industrials, energy. Late expansion. Real estate, communication services. By positioning in the right sectors at the right time, you not only survive cycles, you harness their immense power. Act 6. Preparing for what's coming. Today's markets show troubling similarities to previous pre-crash periods. Valuations stretched beyond historical norms. Unprecedented levels of corporate and government debt. Retail investor euphoria reaching extremes. Technical divergences building beneath the surface. But for the prepared, these warning signs aren't causes for fear. They're invitations to prepare. Stress test your portfolio against 30–40% drawdowns. Build strategic cash reserves for deployment during distress. Identify quality assets you'd love to own at half their current prices. Strengthen positions in uncorrelated assets that historically perform during crises. Consider protective options strategies for essential positions. Market crashes don't create or destroy wealth. They transfer it from the unprepared to the prepared. The question isn't whether volatility will return, it's whether you'll be positioned to benefit when it does. Throughout history, financial markets have followed the same eternal cycle: expansion, euphoria, contraction, despair. What separates those who merely survive from those who truly thrive isn't prediction, it's preparation. At Capital Uncovered, we don't just help you navigate financial storms, we position you to harness their power. Because true wealth isn't built by following crowds, it's built by understanding cycles and having the wisdom and courage to act when others won't. Subscribe now and activate notifications to join those who see what others miss. Because history doesn't just repeat itself, it rewards those who learn from it. Will you be one of them?